Well, hello everybody and welcome to this edition of In Perspective. It's certainly been very interesting times in financial markets recently with much elevated volatility. And what I wanted to do is just touch on exactly why we're seeing the volatility that we are seeing. The recent bout has been caused, it's been a cause of two factors. One is that the slowdown in the Chinese economic growth and how the authorities there have handled their stock market in the last quarter. And I guess the second element really is the US economy and the fact that it is slowing. Let's just look at China first. There's no doubt that the Chinese economy has slowed. And will continue to slow, but more importantly, it's changing from being a very manufacturing-based economy to being more of a consumer-focused economy. Now, this can take a long period of time, and it will take a long period of time, and I guess the ebbs and flows that we're seeing at the moment are very symptomatic of this transitioning economy over the next decade or so. The authorities have plenty of scope to help the economy along. Fiscal spending is up 25%. It seems to be working. Auto sales are up, and I think that the economy is a long way away from falling into recession, as the doomsday sayers have been espousing lately. Certainly there will be slower growth. Certainly they are exporting deflation. And I think deflation is the thing that we actually have to watch coming out of China as they attempt to, re-inflate their economy. The other side is the US. The US has slowed recently, despite the fact that it's showing that employment is fairly strong. Manufacturing is actually on the downside, and in fact, as I look at the US economy, I question the reason behind why the Federal Reserve actually wanted to increase rates. It said that it actually wanted to increase rates because it needs to have firepower for the next slowdown. I think that that's a misaligned view of the world or their economy. And in fact, there is no inflation to speak of, and at least there doesn't seem to be inflation on the horizon that warrants much of a lift in interest rates from here. They did tighten in December. The fact of the matter is that the interest rate trajectory, I should say, that they have signalled to the market is for a 1% lift in 2016 throughout the course of the year. I just can't see that happening. The currency has done a lot of the work for them. It's increased 19% against its major trading partners, and that in itself slows exports down, increases imports, so the economy gets a natural slowdown. So the way I see interest rates moving in the US is we'll probably see one more rise, and I think that then we'll see a very long pause in between. Now, what's interesting about the fact that oil prices have been falling around the world thanks to increased supply and I guess lower demand is petrol prices keep coming down, and that should ultimately feed into consumption, whereby you save money by putting petrol in the tank, and that's real money available to spend anywhere else, whether you pay off your credit cards, decide to buy extra goods and services, or merely save the money. There is a real saving there, and one that can potentially feed back into the economy in the second half of the year, and I expect that it should. Looking around the rest of the world, the low in commodity prices are certainly hurting and will continue to hurt commodity-based currencies, of which Australia is one, Canada is another. Latin America certainly has a world of pain around it, as Brazil has demonstrated recently. And I guess South Africa is the other part of the world which is very commodity based. On the other side of that, though, countries like India, who are very resource dependent, as to is Korea and Japan, they're going to continue to do fairly well. And I think that one of the bright spots in the global economy this year will be the Indian economy. Europe and Japan, the central banks there continue to print money, and really there's nowhere else to put your money other than bonds, which to me look very expensive, or again in the stock market. For me, property and stocks are probably the choice of investments in both those places, and hence we've seen a fairly decent pick-up in stock markets over the last year and a half, without the last quarter being an exception. If we look at the Australian economy, I guess we all know the well-heralded slowdown in commodity prices is going to impact us, and I think that what we're seeing is the beginnings of slightly higher unemployment rates in this country, which don't bode well for growth. But having said that, growth here is holding up okay. It's below trend, which means that you'll get inflation pressures or deflation pressures building as opposed to inflation pressures building, and one where companies are going to be finding it harder to make profits. Now, having said that, BHP and Rio, the share price has fallen on the basis of those commodity prices having fallen, and their profits will in the future be lower than what we have seen in the past. But we're getting companies like Caltex and like Medibank, which are actually revising up their profit growth. And there are some other attractive companies, Macquarie Bank being another one, with some fairly decent growth prospects. So all in all, when I look at the Australian share market and when I look at the top 50, there's some good news stories in there, there's some not so good news stories in there. But all in all, I think that the market could probably finish somewhere around 5,300, 5,350 towards the end of the year. It certainly has bounced strongly off 4,800. And there seems to be some very good value emerging down at those prices. As I said, with the lower growth in Australia, it means that interest rates are likely to remain low, and I think that that if anything, interest rates could potentially be cut, especially if we see out of cycle mortgage rate rises as we did last year on the back of APRA's guidelines to the bank, and particularly in relation to their capital requirements. So the way I see things going is, if they have to come back to market in order to raise more capital from the share market, our Australian banks, then there will be a bias towards interest rates going lower in Australia in the second half of the year. At this point in time, though, it's hard to see interest rates changing at all. So my outlook at this point in time is that we will see steady monetary policy at least into 2017. I guess really, where are the dark clouds on the horizon going to come from? Well, certainly China, and it's been well heralded that any more of a slowdown over there is likely to be something that's not expected. Certainly the US, to me, looks like the biggest risk factor at this point in time, because the Federal Reserve, as I mentioned, is embarking on interest rate rises, and because I can't see any inflation over there, underemployment, and little in the way of wages inflation, I think what you might find is that they might be regretting at the end of this year if they follow the trajectory of having 4 rate rises. I don't think that we'll see a global recession. I think that growth will stay low. I think that inflation will stay low. But at this point in time, I'm fairly optimistic that we will get through the current bouts of volatility that we've seen, and stock markets should end the year only slightly higher, but certainly not in negative territory. I look forward to catching up with you at the next In Perspectives, and hopefully that's giving you some light on what we've been seeing lately. Goodbye.